Hello and welcome to Trading Hour. I'm Sonal Bhutra. With me is Vinny Motiwala. It's a Friday morning and bulls are in the Friday mood today after a long time, I have to say. So after the cuts that we saw yesterday, today there's a gap up opening that we saw and actually we built onto that. So it's a 183 point gain on the Nifty that we're seeing. Yes, it has come off from the highs. It was up more than 200 points at a point in time. For now, it's holding above that 23,500 mark, crucial levels that we are watching out for. And you know what? It's the Bank Nifty which is supporting the gains on the Nifty that we are seeing right now. Mid caps are underperforming today. It's just a 0.3% of a gain that we are seeing on the mid cap index. But other than that, across segments, we are seeing some green coming up on the screen. Except for Nifty Media, all the sectoral indices are in the green. And we've been talking about Adani stocks. They were under severe pressure yesterday, but most of them have seen a recovery from the lows around 6 to 11%. Adani Ports, for instance, from the Nifty pack, it's up in the green at the day's high. And we do have other names as well. They are in the red, but they have recovered sharply from the low. So watch out for that one. But we do have a power pack show, but definitely a lot of stocks in focus.
Absolutely, a lot of stocks in focus. And you know what's interesting, Sonal? Yesterday we had seen PSU banks. Yeah. They were under pressure. Today we're seeing a different story here as well. They have recovered as well. Bank of Baroda, 3% uptick. PNB, SBI, all of them are seeing good gains coming in. IT and Realty, that manages to sustain those gains that we had seen coming in. Even Nifty Realty is holding on to gains of 2%. Nifty IT today is also holding on to gains of almost 1.5%. So that, you know, the gains that we've seen for Nifty Realty and IT, that seems to be continuing as of now. But like Sonal was saying, we have a whole host of stocks that are in focus today as well. And let's start with one of them, Reliance. That is in focus. And why? Because we have a positive note that is coming from JP Morgan and Morgan Stanley. What is the note actually highlighting? What is making them positive on Reliance Industries? Sudarshan is joining in with us with more details on that. Good morning, Sudarshan.
Morning, Vinny. So we have two positive brokerage notes on Reliance Industries. Notes are from JP Morgan and Morgan Stanley. Both the brokerage houses have overweight call on the stock, and JP Morgan has a target price of ₹1468 and Morgan Stanley has a target price of ₹1662 per share, implying an upside up to 34% from current levels. So what does JP Morgan say? It says one of the two drivers of the recent underperformance is weak refining margin, and JP Morgan says that has now started reversing, which is positive. Second, poor retail top-line growth is difficult to anticipate, but expectations after the recent underperformance have compressed. And post-stock correction, implied valuations for retail business are 25 times FY26 estimated EBITDA, and valuations for retail business are now below historical levels, and it's below peer retailers as well. Morgan Stanley says refining margins are starting to recover after two tough quarters, and free cash flow engine should pick up pace as 0.6 million barrel per day of refining capacity shuts in 2025 globally. Also, net capacity addition should be half of the demand growth, and new energy is seeing demand improved outlook. So considering all these factors, both JP Morgan and Morgan Stanley have a positive outlook on Reliance Industries.
Okay, so the O2C business specifically on the refining side set to improve. Thank you so much, Sudarshan, on that. In fact, MRPL and Chennai Petro, both these stocks, standalone refiners, they are also higher on the back of this commentary because refining margins improving is a big positive for them as well. But the other big move that we're seeing is on Praj Industries. The shares are higher by almost 10%. Company has released its growth plans. Vamakshi is here to tell us what are they expecting by 2030. Vamakshi.
Well, Sonal, huge uptick coming in from Praj on the back of positive commentary as well as positive outlook that came in from the management. They're eyeing several opportunities, which include sustainable aviation fuel, biopolymers, as well as energy transition and climate actions. Overall, they have said that they're expecting energy majors to invest 25 lakh crores in the clean energy sector by 2030. Traditional oil and gas market also is expected to invest 21 lakh crores in the next 10 years. Now, what does this mean for Praj in terms of an opportunity? They see significant demand for modularization solutions for setting up plants. And in order to cater to this demand, they're setting up a dedicated advanced manufacturing facility in Karnataka. They made an investment of around 400 crores, and they believe that the plant can deliver revenues of anywhere between 2,000 to 2,500 crores annually at the optimum level. Additionally, they have also highlighted that India has set the target of blending 1% by 2027 and 2% by 2028. This is for sustainable aviation fuel. And EU and USA have kept the SAF blending target of 6% and 10% respectively. So therefore, sustainable aviation fuel has also opened up a new door of opportunity for Praj Industries. Now, overall, given how the demand is expected to pan out, the company expects to triple its revenue by 2030. They have a revenue run rate of 3,400 crores as of now, and this is expected to rise to 10,000 crores. And in fact, their share of exports is also expected to rise from 29% currently to over 50%. So overall, a very strong commentary coming in from the management. Resultantly, the stock is soaring in trade.
Okay, surely keeping an eye out on Praj, trading at the day's highest point as of now. But on that note, we are going to slip into a very short break. Don't go anywhere. After the break, we will discuss what's buzzing in at the commodity space with Manisha Gupta. Welcome back. You're watching Trading Hour on CNBC TV 18. Let's move on and talk about the commodity sector, what is happening there. And we're going to be focusing on gold today. We have Manisha joining with us to give us all those updates. Good morning, Manisha.
Morning, and thank you for that, Vinny. Well, today is the fifth straight day that we have seen gains continue in case of gold prices, and with that, it's trading at a one-week highs. When you look at this week itself, the prices have gained up by nearly 5%, and for this year until now, the gold prices are up by nearly 30% as well. Well, even as the dollar index is holding around that 107, which is a one-year highs, but even with that, safe haven buying continues to come in case of gold prices. There is intensifying escalation in war between Russia and Ukraine. That has been adding premium to prices. And then there are many Fed official speeches as well happening today in the New York session. So before we do see this week, and you could be looking at volatility in case of gold and dollar prices in the evening today. Also, there's a likelihood that the US Fed may not cut interest rates in the month of December. From a probability of that happening from 82.5% in the previous week, right now is as low as around 55 to 56%. So that in turn should have weighed onto the gold prices, but we haven't seen that happen. So after hitting a low of around 25.80 in the previous week, we're trading at around 26.80 on your screens right now. So good amount of gains coming back for this one.
Okay, all right. That's what's happening on the gold side. Thank you so much, Manisha, for telling us what's happening in the commodity space. We'll slip into a short break. When we return, we'll discuss market technicals with Mitesh Thakkar, also discuss the top trading bets. Stay tuned. Welcome back. You're still tuned into Trading Hour. Well, let's talk about the Adani stocks because there's been a sharp recovery from the lows. Remember, there was a sharp fall yesterday, almost on lower circuits, most of them. But today, Adani Enterprises, it is at the day's high, almost a 5%, 6% recovery from the lows. We have Adani Green as well, which is trading in the green right now. It's up 1%. There's Adani Ports and Adani Power as well. These four names have recovered from the lows, but we do have Adani Energy Solutions, which is still in the red. So that is the stock that we should watch out for. Adani Power, of course, is up around 1.5%, but Adani Energy Solutions, that's the stock which should also come up for you on the screen. That one is down around 4% as we speak. So yes, a sizable recovery across the board, barring 1-2 names in the entire universe, but just watch out for that one because there is a definite recovery which is underway. But let's talk about the other name, which is Mahanagar Gas, because the company has finally gone ahead and increased prices in the CNG segment. Now, remember, this is something which was expected, and the company has gone ahead, taken that first phase of price hike. It's a 2 rupee price hike in the Mumbai metropolitan region, takes the total price to 77 rupees a kg. And the company, the last time had increased prices was back in July. And this time around, this price hike has come in because of the cut in domestic gas allocation that we've been talking about. It was a sharp cut, and the expectation was that the companies will go ahead and take a price hike. Now, is this enough is the big question, right? Because this time around, the company has taken a price hike of 2.5%. But considering that there has been a 40% cut in allocation, these companies are required to take a 8 to 10% price hike in order to ensure that they are at least neutral at the margin level. But that is not something that has happened. But despite that, the street is happy about the fact that they've at least gone ahead and done something to maintain their margins. But if they do a larger price hike as well, so that would mean a hit on their volume. So it's a gamble that the companies are taking. But yes, shares. The stock is higher on the back of this. IGL, Gujarat Gas will also be in focus, whether they go ahead and take price hikes. But more important for IGL and MGL, because they have a bigger volume chunk coming in from the CNG segment. But for now, these stocks on our radar.
Okay, surely keeping an eye out on them. But on that note, we're going to slip into a very short break. And after the break, we'll talk to Seshadri Sen from MK Global, who's joining in with us to discuss the growth slowdown concerns. What is the second half going to be looking like for India? Politics, policies, everything on that front. Welcome back. You're watching Trading Hour on CNBC TV 18. Let's bring on board Mitesh Thakkar now, who's joining with us to give us a quick take in terms of technicals and the market. Mitesh, good morning. And markets, good recovery from yesterday, right? What are we expecting now for the next week? What are we looking out for in terms of the market? Any levels that we should be watching out for specifically?
Good morning. So I think, one, we were extremely oversold, and two, I think the good thing was, which happened yesterday, was that the Bank Nifty was the first to bounce back. It hit the 200 average yesterday and then bounced back. And I think that bounce back is still showing signs of continuation. The first level for the Bank Nifty was 50,900. And we got a high of around 59.80 today, but then hourly close didn't happen above 5,900. But my sense is that, as the day progresses, and even on Monday maybe, we will retest those levels. We'll try to get past those levels again and hit towards 50,900. Once that is crossed, then a good chance that the Bank Nifty could, head towards 51,400, 500 zone. So overall, I think that will also propel the Nifty on the upside. So overall, I think the indices would be buy on declines for me. The Bank Nifty, I think, around 50,600 spots, so about 80 points lower, can be bought with a 150-point stop loss for the first target of 5,900 and then eventually 51,400.
Okay, so now any fall would be a buying opportunity according to you, Mitesh. Any stocks that you think could be a good bet, maybe on the downside or the upside?
See, since today morning, I have suggested that, let's lean a bit towards the financial names. So I think the Bank Nifty has done well, but I think the Nifty IT is also, showing signs of momentum on the upside. So my picks over there would be HCL Tech. Buy here with a stop at about 1850. Look for targets of 1900 plus over here. And the other one which I like is Tech Mahindra. I would want to see the stock stabilize above 1735. So it's about 8-9 points lower from there. But above that, buy with a stop at about 1710 for targets of 1780.
Okay. And Mitesh, any picks in the mid-cap space that you would be looking at as of now, or maybe with your more skewed towards large cap?
I'm clearly skewed towards large cap. The idea is that the indices have fallen a lot. So when the bounce back in the indices happen, I think it will be led by large cap. So in the short term, extreme short term, which is about 2 to 5 days, I think my bias is clearly towards the financials and the IT names.
Okay, all right, financials and the IT space. Thank you so much, Mitesh, for joining in as always and taking us through your technical picks. With that, let's move on and get in Seshadri Sen, the head of research and strategist at MK Global. They made a trip to Delhi. So there have been a lot of takeaways and what's happening on the policy front as well. So let's get that conversation going. Seshadri, good morning. Thank you so much for joining in. Well, tell us more about this trip of yours. What was the on-ground situation? We've been talking about this consumption decline. There have been conversations in the circles. We are looking forward to an RBI policy as well. Do you think we will see some action on the back of the slowdown in consumption that we've been seeing?
So our takeaways were in three sections. The first is that the first worry is that capex has slowed down significantly in the first half. The general feeling in Delhi is that was more idiosyncratic, based out on the elections and a very heavy monsoon, which has delayed the pickup in government capex. And we should see a slight acceleration in the second half now that things are settling down. The second one wrinkle there, though, is that given the hard limits on state borrowing, the recent pickup in welfare spending from the states will probably slow down state capex. So central government capex should pick up in the second half. The MK view is that it will probably miss the annual budget targets by a small bit. But second half should be much better than the first half in general. But on the state side, we should expect a slightly slower capex trajectory because of the pickup in welfare spending that we've seen over the last 2 years. On consumption, the corporate results has raised some worries, but there is no alarm in Delhi at the moment. The overall macro data is at worst mixed. Yes, there is a feeling that the RBI tightening has played a role. But given the complex geopolitical situation, the DXY rally, etc., I think the RBI will have to decide at its own pace when it is a good time to unwind its overall tight monetary policy stance. And they've already made a first step there, I may point out, by moving their liquidity stance to neutral. So those were the two broad takeaways as far as the domestic economy is concerned.
Absolutely. Those are the important takeaways on the domestic economy front. So one of the points firstly I want to pick out on is in terms of consumption. Q2 wasn't that exciting in terms of a trend there, but what are we expecting in terms of the second half? And is there something specifically that can be done to improve this consumption trend from the government front or the policy fronts that are coming in?
Not everything can be solved by government at short notice, right? So, meaning consumption has slowed down. There is a base effect there. We all know that at the state government level, there is a considerable amount of welfare spending, which is a consumption stimulus by itself. Is there alarm in Delhi at the slowdown in this consumption? No. At the moment, the feeling is that it's probably a cyclical slowdown. It may not be as bad as the corporate results suggest. In due course, if the RBI starts to ease up a little bit, some of this will get solved by itself. That was the broad feeling that we came away with, but they're continuously watching it. Yes, if it does continue to slow down, then I think, there may be some intervention needed sometime in calendar year 25. Having said that, our view is that this will be a slightly prolonged consumption slowdown. There are multiple factors. There's a base effect. There is the impact of what was a very poor white-collar job market in the second half of FY24. That's having a delayed impact. Longer term, we are not worried at all about consumption. This is MK's view. As India moves up the per capita income charts, there will be a continued exponential growth in many categories in consumption. But yeah, we may have to live with a quarter or two of a slowdown and wait for us to see how that evolves. The white-collar job market itself, especially if the IT sector recovers, is showing signs of improvement. So that will solve part of the problem as well.
Okay. So the white collar job part of things are improving, or at least the consumption story will continue, according to you, Seshadri. There's a lot happening in the geopolitical arena as well. We have a new president coming in the US. How do you see that thing changing things for India? Do you think still the focal point will continue to be India for global investors, for consumption patterns as well?
Yeah, so that was also part of our discussions. We spoke to 2 or 3 geopolitical experts while there. At a first order level, India is not worried at all. The India-US strategic relationship has survived multiple precedents, and Trump, if anything, has been a good partner for India in the past. So there are no immediate worries. A tariff would, of course, hurt India, but it would hurt all of India's competitors equally. India is not being singled out. So that is not incrementally that much of bad news as far as India is concerned. There is, however, a short-term second-order problem that India may have to deal with. If US and China do enter into a tariff or a trade war, right? US imposes tariffs, China depreciates the currency. Then that instability, especially with global dollar strength, could have an impact on India's flows and India's external account. And that is something India has to deal with. Our view is that if it happens, it will be strictly short term. It will be a two at worst 3-quarter phenomenon. And we are in a period where India's current account deficit and forex reserves are at all-time, strong positions. So it's not something that's going to majorly destabilize India or even the Indian markets for an extended period. But that would be the key second-order geopolitical risk that a U.S.-China trade war could bring in.
Sure. And Mr. Sanchez, the last word in terms of the political scenario in India, right? General elections is over. Tomorrow we have Maharashtra's election results. And next year we're watching out for UP Assembly elections. So that state elections, those keep continuing. Anything that we have to worry on that front or anything that one should be watching out for over there?
At the moment, no. I think the big event is over. It was the Lok Sabha elections. There was a bit of a setback for the NDA. And they've seemed to have taken it in their stride at the moment. But the key factor we are watching out for is that does that mean that the government pivots from capex-led state, federal spending to a little more bias towards revenue expenditure and welfare? The final budget of FY25 did not seem to reflect that, and we don't think that that is the case. Yes, at the state level, and we've written on this, there is a pivot towards welfare spending that started actually before the Lok Sabha elections of 2024, and that is continuing, and that we saw in a slightly exaggerated manner in Maharashtra. So our take is that whatever one had to, whatever the impact of politics and political developments have already been absorbed. FY20, we have Bihar and UP coming up over the next 2 years. But, no signs at all, at least from what we see and from our conversations with some experts in Delhi, that there is a pivot away from the overall economic thinking or the economic policy of the government, which is based on, higher capex, focus on macro-financial stability, and a sharp focus on inflation. None of these seem to be changing at the moment. So we don't think that politics is a major worry over the next 12 to 15 months.
Okay. All right, take that point, Seshadri. So consumption, that was the big worry, but it seems that that is not something that the government is worried about. So we'll have to watch out for the outlook on that one. Thank you so much for joining today with your insights and the takeaways from this policy trip. Time for a short break now. Saurabh Agrawal from EVA India and Sabyasachi Majumdar from CARE Ratings will join in on the other side to discuss the impact of China slashing export duty rebate on many key components, including solar panels, solar modules, etc. Welcome back. You're still tuned into Trading Hour. Well, China has slashed rebates on key components, including solar panels, solar modules, and the export rebate cut has been from 13% to 9%, which will be applicable from December 1. What does it mean for Indian solar companies? Will they have to pay more for such items? Will it increase costs for them and the related components as well? To discuss the impact of this, we are now joined by Saurabh Agrawal, tax partner at EVA India, and Sabyasachi Majumdar, senior director at CARE Ratings, joining us now. Gentlemen, good morning. Thank you so much for joining in. Mr. Agrawal, let me start with you first up. Can you give us a sense of what has led to the sharp cut in export rebate? And is there a possibility more cuts would happen? And what is the impact that we're seeing on the industry?
Look at over a period of time, all these export rebates have to go away because end of the day, the industry has to survive without these export rebates being into the picture. What I think China has done is that they have reduced the export rebate from 13 to 9% on cell, module, glass. And if you look at some of the other components, which is say some of the aluminum components and copper wire components, they have reduced the rebate from 13% to 0%. This in turn entails that the price for all these components and and cell and module will likely increase. Even for the existing contracts, it will increase. Effectively, what China is doing is that they are going into stabilizing the things now by way of ensuring that they are not passing on too much of the rebate into the market and ensuring that the market is determining the right prices. This is good for the industry in India as well, because when we look from a competition standpoint, from a China perspective, now that the price will increase, the Indian manufacturers in turn will also be able to have a competitive advantage in this particular case.
Okay, sure. Mr. Majumdar, let me bring in your point of view as well on this one. So, what are you expecting in terms of specific products or entire value chain? What is the impact that we're watching out for right now? Like Mr. Agarwal said, obviously these rebates at one point of time have to go away. But currently, what is the impact that we're watching out for here?
So basically, right now, we have this ALMM regime in the country where, the modules largely have to be domestically manufactured for a large part of the total, output as covered under ALMM. Eventually, the government's plan is to move to ALCM also, where not only modules, but cells will also have to be manufactured largely in-house. Now, if you look at the current impact, this, change in rebate from 13 to 9%, that would result in a increase in price at the module level of about 2 to 4 cents per watt peak. In terms of tariffs, it means for every 1 cent increase in module prices is roughly about 6 to 7 paisa increase in tariff. So it would result in a increase in tariff from anywhere between 12 to maybe 28 paisa. That is the ballpark range we are talking about. No, since we are now going to be mainly, at least till the time our own domestic cell capacity is stabilized over by FY 2027, we'll be largely be producing most of our modules in-house, and but they will be impacted because of the increase in the cell costs. But obviously, it will not be to the extent of 2 to 4 cents because a part of the value addition also happens in the domestic market. But nonetheless, there will be some increase in price of the modules because there will be an increase in the cell cost.
And Mr. Majumdar, what is the dependence that we have on China when it comes to modules and cells? I believe there's a big dependence that we have, right?
Yes. Now, going forward, the majority of the modules will be able to do in-house. But till the time the new cell capacity is stabilized, we'll be dependent to the extent about 80% for maybe a year or so.
Right. Okay. So 80% or for a year or so is what we're looking out for there in terms of a number. But
with these new cell capacities, I think that dependence will also be coming down. But having said that, even after that, we'll continue to be dependent on them for wafers. Eventually, our plan is to go down to wafers and maybe at some stage polysilicon itself, as and when the market becomes big enough. But still, we'll be dependent on Chinese for wafers and cells. And apart from the main, components which go into this, there are also a lot of, these small chemicals, glass. Obviously, the plan is for us, India also to get into, ancillaries like glass and other things which go into manufacture. But for many of those ancillaries also, apart from the main cell component, there will be some dependence on China.
Sure. Some dependence will be there. That will continue. Mr. Agarwal, I want to know, are there any other taxes that these Indian manufacturers on import of solar panels specifically and cells that they're paying currently? And, anything that is there on that front in terms of import duty or anything that we should be watching out for?
You see, the way India has decided in, I think, April 22 itself, they've increased the rate of customs duty on module to 40% and on cells to 25%, which in turn, I think the focus of the government was to ensure that the cells and modules are manufactured domestically. And that's why, if you see, ALMM anyways is in picture today, and ALCM is planned in 2026. I don't foresee that there will be a significant rate increase as far as the module and cell is concerned. But of course, over a period of time, as the government pushes the agenda for manufacturing of wafer ingots and polysilicon into the country, you can likely foresee some increase in duties in this particular area, which is wafer, cell, and polysilicon.
Okay, so take that point, Mr. Majumdar, comment on this. So, what is the key takeaway? Is it a negative in the short term, and it is something that we are preparing for the long term for the industry overall? Because still, China continues to be the biggest producer of modules, chips, wafers, cells, you name it, and they have taken control of the entire value chain, right? So, do you think this is a short term negative, and over a longer period of time, the Indian segment, or in the Indian sector at least, will tend to benefit from this?
Yeah, I think you are right. In the short term, there is a negative, but in the long run, anyway, we would want to be, the government's intent is to make us, fully self-sufficient in the entire solar equipment chain. To that extent, these Chinese, the measures that the Chinese have taken will make Chinese exports more expensive, and to that extent, indirectly make Indian manufacturing more competitive. So in a way, it, gels well with, what India is planning to do anyway.
Okay, all right. So this short-term setback that we are seeing, but overall it's a positive. Mr. Agrawal, last question before we let go of this discussion. You said it is applicable for existing projects as well, right? So anybody who has entered into a contract and looking at a supply from China will have to pay at a higher cost. What does it do to the contracts now?
So typically, if you see, and I'll just give an example, someone has placed an order for 2 gigawatt of modules, and say 1 gigawatt has come before December 1. For them, the rebate of duty applicable is 13%, whereas for the future ones, which is coming after December 1, say 1 gigawatt is coming after December 1, there the rebate has reduced to 9% from 13%, which in turn means that the Chinese manufacturer will pass on that particular burden to the Indian IPP, which in turn increases the cost of generation of electricity. The only point before I leave, I think the point which I want to specifically highlight is that the step taken by China is towards the Atmanirbhar Bharat policy of the government as well. It will surely help the overall Indian solar manufacturers in the long run. Maybe in the short run, there's some impact on the costs.
Okay, so a step taken by China is helping India. So good going for the solar industry at least, of course, going forward. Thank you so much, gentlemen, Mr. Agrawal, Mr. Majumdar, for joining in with your insights and making sense of this move that has come by. It was scaring the street a little, but looks like it's a short-term negative, but in the longer term, it serves the purpose of the industry as well. With that, we'll do one thing. We'll slip into a short break. Up next, we'll get you exclusive excerpts from our conversation with the CEO and co-founder of Zepto as the company raises $350 million domestically in the largest ever for an Indian startup.
Welcome back. You're tuned into Trading Hour on CNBC TV 18. As of now, the Nifty is trading almost near the day's highest point, up 0.9% in trade. 23,500 levels is what the Nifty 50 is holding on to. Stocks that are supporting the up move today, we have ICICI Bank, SBI, Reliance, Infosys, TCS among the top pullers for the market and top up moves for the market that we're seeing coming in for the Nifty 50. Let's look at what the Nifty mid and small cap is doing. That was a bit of an underperformance versus the benchmark indices, but still managing to hold on to some bit of a green is the Nifty mid cap as well as a small cap, both holding on to gains of almost 5/10 to 7/10% in trade. But as we wrap up this edition of Trading Hour, we're going to leave you with an exclusive conversation that we had with Zepto that has raised $350 million in what is the largest 100% domestic fundraise for a private startup in Indian history. The quick commerce delivery platform's co-founder Adit Palicha also spoke to Shriman on this fundraise and the business of the company. Listen in.
Let's address the narratives with facts, and I want you to put the numbers down on 100%. The table, because KATE, which is the Traders Association, has basically told the government as well as the general public that quick commerce is bad. Quick commerce is going to kill the Kirana stores, that quick commerce is taking away jobs at this point in time. I want you to first, there is price gouging, there's discounting, there's a whole plethora of charges that have been made against quick commerce in general, including each one of you. Now, I want you to address each one of those aspects. Let's start with the discounting issue, because that is something that the government also is concerned about.
100%, and let's go through them one by one. Would love to do it, and we're data-driven guys, right? So we'll make it happen. But the first one is on predatory pricing. I'll give you an exact data point. So that that allegation is false unequivocally by data. If you look at the exact number of units sold on the Zepto platform in FY24 that was below COGS, it was 0.2%. Only 0.2% of our units were sold below cost price of the manufacturer. 99.8% we were making margin on it. 99.8%. Right? Even in the stores that we
And
had,
who's verified this?
this is EY verified. I'm happy to, I'm happy to go, publicly and say anyone that wants to diligence this, please come into our office. Let's look at the books, right? Because we've got data and facts, and there are anecdotes and hyperbole, right? And we're on the side of data and facts. So 0.2% of our units were sold below cost price in FY24. We don't expect the number to change in FY25 much, but we've got book closure numbers for the full year FY24. That's one, right? Even if you look at the stores that we were profitable in, which we turned hundreds of stores profitable, and it's a well-regarded fact, even the market, the investors that came in here, investors like Ramdeo from Motilal Oswal, or all the Ranjan Pai from Manila Group, that diligence was done in our stores. Even in the markets that we were profitable in, we were meaningfully lower than MRP. So are we predatory pricing? The answer is no. If you look at it, we've created structural deflationary value. We've cut out all the inefficient middlemen that exist in the value chain for grocery, the distributor, the wholesaler. We go straight to the manufacturer. We're procuring, millions of products at scale, getting it at a better price. That goes into the platform at a better price for the consumer than MRP, cutting out all the inefficient middlemen that have been sucking out value, and the consumer has had to pay at MRP. So we've structurally reduced the price. We've been able to turn our stores profitable, and that means we're not predatory pricing. We're actually deflationary, right, for tens of millions of consumers. So that's a headline. With zero predatory pricing, quick commerce is deflationary. We can prove it in the profitability that we have in our store P&Ls. We can prove it with the number of units that were sold below margin, right? We've got all the data. Obviously today, we're expanding on a base of, billions of dollars of scale. We're investing in CapEx. The biggest singular line item today in our P&L is CapEx, directly or indirectly, right? Not all of it shows up in fixed assets. Some of it is in an OpEx model to go into the technicalities. But if you look at the capital being deployed, the biggest part is CapEx and working capital. The second biggest part is operational setup. The first question you mentioned, are we predatory pricing? Answer is no. Happy to go into the data, happy to go into our books in detail. 0.2% of products below margin.
Okay.
And stores profitable, still below MRP, because we're deflationary. We've created value in the supply chain. That's one. Second piece on jobs, created over 4.5 lakh jobs. We've estimated, and from the surveys that we've done at scale, statistically significant, that, even the people that were employed were making 10 to 15,000 rupees per month. And now they're making 23,000 rupees per month, right? So we're a net job creator. We're net wage additive. And, we're not predatory pricing.